In this video, traders, we're going to look at the difference between daily rolling and futures. What is the difference? Stay tuned. Hey guys, warm welcome to you. So when you open up your spread betting platform or maybe a CFD platform, and by the way, if you're looking for a spread betting broker, check out our channel sponsor in the description below. But if you're opening that up and you're looking at your watch list, you might find, for example, on FTSE 100, DAX, or they call it German 30, US 30, US 500, some of the major indices, you might have a couple of options. And one of them is a daily rolling cash or a rolling cash or a daily rolling or a daily funded, something along those lines. And the other is a futures contract, and that will probably be shown as something like UK 100, which is the spread betting brokers synthetic FTSE. They can't actually use the FTSE, but it's pretty much tracks the FTSE and will expire based on that if it's a futures contract. So UK 100, and then it will say the expiry date, so September 2019, for example. Now you need to look at the info tab. Normally it will be based around to see the exact expiry date, but generally speaking, that's how it will be positioned. And this might also say something like cash underneath for the cash one. Now the biggest thing you'll notice is the spread difference. You'll notice that the spread, let's say for a FTSE 100, for example, or UK 100, about 0.8 points. Futures contract 4 points, so a big difference. You might say, well, why would I trade the futures? Well, that's a very good question. And if you're a day trader, you wouldn't. It's a simple, fast, hard and fast rule for that. If you're a day trader, you want to trade the product with the tightest spread because you're trading intraday, you're coming out at the end of the day, you've got no overnight carrying cost charges. We'll get to in a moment, which is what the futures contract and rolling is all about. So day trader, you trade the rolling, don't worry about the futures, don't have to get involved in it at all. Okay, so what's the major difference? So tighter spread on the rolling, wider spread on the futures contract. Now, with the daily rolling, you've got no expiry. Basically what's happening is in the evening, normally about 10 o'clock at night, UK time, then you will have the contract rolled over to the next day and you'll pay a charge. We'll look at how much the charge is in a moment, but it will just stay open indefinitely, either until you hit your limit, you stop, or you close the position. A futures contract, however, will continue to stay open until that expiry date. So when that expiry date hits, it expires based on the rules with your broker, normally on an underlying price, whatever that price is, and it'll be settled based on that price. And you can roll it, but we won't get into that at the moment. Most of the time it expires and that's it. So if you're looking for a longer term trade, then maybe the futures contract is the one to trade, the one to buy, because the main thing here, guys, is the overnight charge. Okay, you don't have any overnight charge. It's all rolled into the spread with the futures contract, as is the dividends. So any dividends you're going to pay, are going to receive or pay out if you're short on the UK 100 will be rolled all into the spread. So there's no adjustment for that. Daily, you do get those adjustments on the dividend days. The overnight fee, this is the big one. So no overnight charges for the futures contract. Overnight charges for the daily rolling or daily funded, however you want to call it. So rough example, this is how it is worked out. So LIBOR is really the key for this, guys, and LIBOR is London Interbank Offered Rate. It's basically an aggregate of the overnight rates that banks will lend to each other at, the interest rate they'll lend to each other at, and it's the 1 month LIBOR. Now, again, check with the broker that you're using to get the exact details. This is kind of a generalization. So take the 1 month LIBOR. At the moment of filming this is 0.72%. And the brokers add an admin fee, because this is how these make their money, guys. They make their money from the overnight financing charge. They make their money from the spread. This is one of the ways these guys kind of keeping the doors open, so to speak. So the admin fee, 2.5% plus or minus 1 month LIBOR, which is 0.72%, divided by 265, because it's a daily charge. Not going to be a whole lot, obviously. So every day you get a daily charge. To get that, they just divide it by 365. That's UK specific. Some slight differences in other countries, so check that out. All right, so for long, what's the example? Long is 2.5%, which is the admin fee of the broker. Again, depending on the broker you're using, plus 0.72%, which is the LIBOR rate, gives you 3.22% annual, divided by 365 to get your overnight charge. Now, if you're short will be 2.5% minus the LIBOR rate, because you're short. 1.78% divided by 365 is your financing charge. If the LIBOR rate was a lot higher, you could see at some point potentially you could be paid to hold this in theory. Right. Let's look at a rough example. £10 a point on the FTSE 100, says at 7,000. Your notional value is 70,000. Bear in mind, this is a quite a sizable example. If you were trading a stock, a £70,000 position would be quite large. But because you're trading an index, you have to get that notional up to get some return on your investment, so to speak. So 3.22% is our LIBOR plus our admin fee. Divided by 365 is about 0.0088% per day. All that works out, times in by the 70,000, works out about £6 per day, give or take. So you get the idea of how you calculate something like that. And obviously, if your position size was a £1 a point, it'd be 60p a day. So you get the idea. So you choose what you're trying to do, really. If you're holding it for a certain period of time, you might say, well, a futures contract's better. I'm prepared to pay my £40 up front. Or actually, you know what, I want to be able to job in and out of it. I might close it after a couple of days, in which case maybe you're better off trading that because you pay your spreads. A couple of days on that is cheaper than holding a futures contract. But the rule of thumb that we know is true is if you're day trading rolling any longer than that, then you might want to consider the futures contract, specifically if it's kind of up to that expiry, or you're just looking to hold it up to that expiry. All right, guys, that's the difference between daily rolling and futures. See you next one. Take care. Bye-bye.